Rates on hold, rates about to cut. How does it affect property prices, and when should you get into the market just to time it right as the boom happens so that you're not paying more for the property? Today, in this video, I'm going to be showcasing how the impact of one interest rate cut ricochet all the way through your investment journey, how you must get into the market right now, but what to look for so that you don't get into the pitfalls and that you make the mistakes that stops you from capitalizing on the growth that is ahead. My name is Helen Tarrant. I've been helping everyday Australians become wealthy through investing in commercial property, and I can help you do the same. All you have to do is subscribe, hit the bell, and schedule a free strategy session with the link below. Now let's get started. So, what does the rate cut really mean to you as an everyday Australian trying to pay the mortgage, trying to grow your wealth, trying to retire wealthy? Firstly, every time there's a rate cut, everyone gets a consumer boost. So confidence boost. So what that means is like going, great, we are now can afford more things. We are not putting all of our money into the mortgage because let's face it, we are paying the mortgage first before we pay everything else. Now we can afford extracurricular activities for the kids, maybe a dinner out, maybe on a holiday, all of those things that now that money's rediverted back probably into the economy, which fuels the fact that the economy feels better and everything keeps growing and growing and growing, right? So we're spending more, therefore the economy is growing, the prices go up, and it becomes that effect so that we feel wealthier and we have more money in our hand. But truly, what does that mean for you right now with the pressure of the cost of living and also in terms of you investing in the next property? Recent articles, this is really interesting. This recent article from the actual ABC News have actually said that if there was a rate cut, a whole rate cut of 100 basis points, now we're not there yet. We've had 3, so we're at 0.75. So we're 75 basis points. We will be at 100 basis points, maybe at the end of this year, maybe early next year. Now, there's some signs that says, yes, we may have a rate cut in November, or we may actually get that pushback depending how the economy is going. Now, a whole basis point will lift property prices up by 9%. 9%. Potentially with more rate cuts, it might get to 11.5%. So, how does that happen and how fast does it happen is what you need to know so that you can actually pinpoint the right time. So let me tell you what's really happening in the market right now, not only in property, but also in commercial property as well. We are here at Unicorn, a buyer's agency. So I run a company called Unicorn. We're a specialist education buyer's agency to help everyday Australians transition from residential property to commercial property and create that passive income, multiple streams of passive income so you can retire sooner. And did you know that through commercial property, you can retire in half the time you would in residential if you invested in commercial property? And I'm going to share that with you on a free strategy call. So make sure you book in for that. Why does investing right now make sense, especially when we're thinking we're going to get 9 to 11.5% growth in the next potentially 12 months, or has that already happened? You see, this is really interesting also. We looked at the confidence of the annual growth, right? We also looked at the annual growth rate of rising, and this was in the news.com.au recently in August, right? That our median home prices in Australia have gone up to 835,000. Now, if you live in Sydney, 835,000 doesn't really buy you very much. But if you live in Melbourne or Adelaide or Brisbane, it becomes a little bit more affordable. But that means a 5.3 year-on-year growth, but also that 8 consecutive months just because we started having a rate cut back, 8 months ago, or a little bit more, probably 9 months ago. That's what's fueled the month-on-month growth as well. When do we see that full 9% growth? We see, the thing is, when you have the first cut, most of the market don't react to go and buy something. They react with, oh, finally, there hopefully won't be a rise. Then when they have the second rate cut, most people go, okay, this is going to become a norm. We're going to see more of it. So let's get our ducks lined up. We have the third cut. People go, this is happening. We have to buy now. So this is where we are now. We're at the time where people have started 8 months ago thinking, this is pretty much, we don't know if it's going to continue. To the second rate cut, we're going to go, let's get our ducks lined up. To now, people going, okay, let's buy now because we know what's going to happen. We'll have 1 more or 2 more rate cuts. Everyone's going to come into the market. So this is the time to buy now. 3 to 6 months is what you have to get into the market before we have that huge wave. See, this is what happened is that almost everybody lines up the ducks at the same time, execute into the market, and we all of a sudden see a 10% jump. The last 8 months and now we've seen incremental little bits, but we haven't seen the massive jump, right? Which we're about to happen in probably early to mid next year. So that will mean that people all of a sudden see, oh my God, we are paying 10% more for the same property, and it happened in a blink of an eye. Did we miss it? What happened, right? No, they didn't. They just missed all the signals along the way, and I don't want that to happen to you. That's why you're watching this video. So I'm going to share with you a few tips on how to actually get into the market right now so that you are doing the right things. Firstly, if you haven't refinanced, you need to refinance. If you haven't and you don't have a property, you need to start, even if you might have $50, $80, even $30,000, start planning to buy that property now. Doesn't matter whether you're buying a $300,000 property, a $500,000 property, or $1 million property. Whatever it is that you buy, you need to start organizing that. So that means that if you can refinance and pull out 200K, 500K, fantastic, go and buy, get prepared to buy that property. Whatever it is you need to buy, you need to get into the market so you can make a 10% gain, right? And imagine in commercial property, you get cash flow as well as this gain. Why wouldn't you right now? So if you can pull out more, this is where people who are at the top end, so if you're at 1 million, 500, 2 million, this is where you start to have that exponential effect, right? So you're compounding. When you have $1 million and you put that into commercial property, you're buying a $3 million property, you're compounding. Your 10% is 300,000, right? And that means compounded in the next couple of years as the rates come down, you're making exponential gains. With also a cash flow coming in, you could be getting 15 or 20% return on your investment. So this is why you need to position yourself so well. Also, I want to share with you quickly these equations of why at the moment some people still haven't got into the market, even though we've had 3 rate cuts, but it makes sense when they get to the 4th and the 5th. So let's look at this as a scenario buying a $2 million property. So let's say you have a $2 million property that you're going to buy. Now, if you're doing a lease stock loan, which is dependent on the lease itself, not on you, you're going to be going up to an LVR of 70%, which means 30% is going to be the deposit you're going to need. Now, the deposit might come from an equity drawdown. It may be cash, whatever it happens to be. It is the deposit you're going to need for the bank to finance the rest. So on a $2 million property, you're going to need $600,000, but also remember you need some costs, buyer's agency fees, lawyers, valuation, all of that might come up to 5 or 7 or 8%. So you're going to need $100,000 for your stamp duties and everyone, and probably another $30,000-$40,000, so another $120,000 $140,000. So all up, you're going to need somewhere around $700,000 to $750,000 to be able to complete the deal for a $2 million purchase on a lease stock loan. Now, let's assume you're putting in the cash for the stamp duty, for all the costs associated, but the actual deposit is a drawdown on the equity that you have. That 30%, which is that $600K, is actually coming from equity. So there's a price attached to it, which most people forget in residential, but there's a price interest rate to that. So that might be 5.5% now with the market and the interest rate. Now your commercial loan is going to be sitting around 6%. So let's just say that combined, you're paying 6% on the $2 million. So that's about $60,000 in repayments on every million. So there's $120,000 for the $2 million to service the debt. If you were originally, when the interest rate were high, like 6.5% or 7%, you couldn't break even by buying into a metro area. You couldn't break even if you bought in Melbourne, in Brisbane, ACT, Adelaide. You couldn't break even because the returns in those areas were somewhere around that 5.5%. However, because interest rates were high, people weren't buying into those areas. Those returns have come up a little bit to around that 6% mark because the vendors realize they don't have the same pool of investors. Now you're getting slightly higher returns in those metros because people haven't flooded back. But when interest rate goes down, and it now becomes affordable to come back into the city, most people prefer to buy in metro versus regional. So what's happened is that as we have interest rate cuts, more people are going to leave regional and then come into metro, and we're going to have a metro boom. Having a metro boom means that you're going to actually get capital gains on the back end, like that 9 to 11%. In residential, just like in commercial as well, you're going to get that as the market surges and the confidence comes back. However, now you're going to get cash flow as well, which is what you don't get in residential. So 6%, so $120,000 to break even on a $2 million property. If you're getting $120,000 in net rent, so rent as you buy into the property itself, which is a 6% return in metro, and recently we've done a couple, and here's a couple. There's one in Surrey Hills with a Pilates studio that our clients have just recently bought. There's about 6%. There's the one that I've just visited, which is one in Sydney, a little cafe near Macquarie University, which is also close to 6%, nearly $2 million. They both are going to be breaking even when you first enter the market, when you settle it right now. So these people are getting in ahead of the market. However, when the interest rate has one more cut, whether it's later on this year or early next year, what happens is that your 6% interest goes down to 5.75. So now your mortgage repayments is $57,500 on every million. So instead of 120,000, it's 115,000 on the $2 million. However, you are getting $120,000 in net rent. So that means that you're making $5,000 in positive cash flow. The rate cuts again by 0.5%. Let's say next year sometime, you get an extra boost of $5,000. So every time it cuts by 0.25 basis points, you get a $5,000 increase in income, an increase in your paycheck, or increase in your wealth or your cash flow. So let's say that by the end of next year, we have another 3 rate cuts or even 2 rate cuts. You could be with, also don't forget, you've got rental increase as well, but you could be making $15,000 to $20,000 on that $2 million property, but also picked up a 10% capital growth. So you would have made a $20,000 in cash flow at the end of next year, plus $200,000 in capital growth as well. That's why commercial property is now going to become the hottest commodity, hottest industry to invest into in the property space. So if you want to get ahead and you don't want to miss out, but also you want to get ahead and you want to make sure you buy the right properties in the right area to get the gains, because these 2 properties that our clients have recently bought we've tested the market. We know what the market, we know the area, we know it will grow in value. One of the first areas to grow in value because of density, population, and demand. We can position you so that you are right for the next steps in building your wealth and leveling up to commercial property. All you have to do is book in the free strategy session below, and one of our property specialists will take you through the process. My name is Helen Tarrant, and I hope you've enjoyed this video. If you did, leave us a comment. Let me know whether you want me to do something in-depth about an area, about the type of property you should be investing in, what class of property. Just put that comment in below, and I'll do the follow-up video based on your comments. So make sure you do that. Until next time, keep hunting, keep looking, but build your wealth with strategy and plan with a big picture in mind. You're going to succeed in half the time as you would invest in commercial than in residential. Hit the bell, subscribe. See you in the next video. Bye for now.